All right, let's dive right in. Welcome to this explainer, where we are doing something incredibly fun today. We are putting United States Lime and Minerals through the ultimate valuation test. You know, as an investment analyst, it's just never enough to glance at a stock chart and call it a day. We need to run the hard numbers through the battle-tested frameworks of some legendary investors. So, we're going to apply the distinct philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham, and then stress test all of those findings against modern discounted cash flow and comparable models. Let's see exactly how this company holds up. Here's our roadmap for the gauntlet. We've got 1, the USLM snapshot, 2, the Buffett lens, 3, the Lynch lens, 4, the Graham lens, 5, DCF and comparable models, and 6, synthesis and final verdict.
Section 1, the USLM snapshot.
Okay, so the contender entering the ring today is United States Lime and Minerals, ticker USLM. They are a supplier of absolutely essential materials to the construction and energy sectors, sitting on a market cap of just over $3 billion. And look, they are operating with an incredibly pristine balance sheet. As of March 31, 2026, their cash and cash equivalents sit at a massive $383,165,000. Oh, and they have literally zero debt outstanding, plus an entirely untouched $75 million credit facility. In an era where everyone is highly leveraged, USLM is basically a fortress of cash.
But we do have some real narrative tension here. While that balance sheet, as we said, bulletproof, their recent Q1 2026 earnings report actually missed the mark. We saw some softer demand from construction, oil and gas, and roof shingle customers. Because of that volume drop, along with some higher fuel costs, Q1 net income actually fell 10.4% year over year. That dropped their earnings per share down to $1.06 compared to $1.19 the year prior. So the setup here is a wildly cash-rich company that is currently facing some short-term operational headwinds.
Section 2, the Buffett lens.
We know Warren Buffett hunts for wonderful companies with deep economic moats and super strong returns. On the qualitative side, USALM easily passes his tests. Limestone is incredibly heavy and really expensive to transport, meaning these lime plants effectively operate as regional monopolies. That is a fantastic economic moat. Furthermore, if we take their Q1 net income of roughly $30.6 million, annualize it out to about $122 million, and divide that by their $661 million in stockholders' equity, we get a highly robust annualized return on equity of around 18.5%. Combine that with the zero debt we talked about, and Buffett would absolutely love the financial discipline here.
Now, Buffett also demands we calculate owner earnings, basically the true cash a business actually generates for its owners. So for Q1, let's take their $30.6 million in net income, add back $6.5 million in non-cash depreciation, and subtract their capital expenditures of $18.3 million. That leaves us with $18.8 million in Q1 owner earnings. Now, I know what you're thinking. That CapEx number looks a bit heavy, right? But here is the context. $10 million of that is a temporary investment into a massive new $65 million vertical kiln down in Texas, which means their underlying cash generation is actually even stronger than this number suggests. It's just being temporarily suppressed by some really smart growth spending.
Section 3, the Lynch lens.
Peter Lynch famously likes to categorize companies to understand their growth potential, and he would perfectly label USLM a stalwart. They are a steady, highly profitable producer in the incredibly boring but literally essential lime and limestone space. And remember, Lynch loves boring industries because they usually fly right under the radar of institutional hype, which allows steady compounders to just quietly keep doing their thing year after year.
But Lynch is also a huge stickler for valuation. He famously uses the PEG ratio, which is price to earnings divided by the growth rate. So with a PE ratio of 23.3 times at the current $106 price tag and recent Q1 earnings actually contracting by 10.4%, well, the PEG ratio screens a bit high, or technically negative, for Lynch's usual taste. He normally wants to buy growth at a nice discount. But wait, there is a hidden structural strength here that would definitely make Lynch sit up and pay attention. You see, Lynch absolutely loves heavy insider ownership because it aligns management directly with the shareholders. And USLM shines brilliantly right here. A private holding company called Byrne Enterprises controls a massive 61.5% of the outstanding shares. That means the actual public float is really quite small.
For Lynch, having this heavy insider conviction, combined with that pristine balance sheet we saw earlier, makes USLM an incredibly compelling hold, even if the PEG ratio is currently a bit skewed by those short-term construction headwinds.
Section 4. The Graham Lens.
Okay, now we are stepping into the strict, unforgiving, quantitative world of Benjamin Graham. Let's run USLM through his defensive investor checklist. Graham cares about hard assets and massive margins of safety. Adequate size? USLM easily passes with its $3 billion market cap. Financial condition? Massive pass. Their current ratio is over 20 times. Earning stability is a clear pass too. But then, we hit the valuation wall. Graham really wants a PE under 15. USLM is at 23.3. Graham wants a price to book under 1.5. USLM is at 4.6. So on strict valuation metrics alone, USLM completely fails the Graham test.
And honestly, if we explicitly calculate Graham's famous intrinsic value formula, it gets a bit worse. You take the square root of 22.5, multiply it by their annualized EPS of $4.24, multiply that by their book value per share of roughly $23.10, and we arrive at an intrinsic value of about $46.90. Compared to today's actual share price of $106.47, that is a massive negative margin of safety. Graham would argue you are paying way too much for the underlying assets today. He wouldn't touch this stock unless it experienced a 50% haircut.
Section 5. DCF and comparable models.
All right, let's strip away the qualitative feelings of our gurus for a second and just look at pure modern mathematical models. A standard discounted cash flow, or DCF, requires us to forecast future free cash flows, calculate a terminal value, and discount it all back to the present day using the weighted average cost of capital. Based on the data extracted from Simply Wall Street's model, they arrive at a base case fair value of $102.67 per share. So, against the current price of $106.47, the DCF actually suggests the stock is currently trading at just a very modest premium to its fair value.
Looking at a comparable multiples model gives us another vital perspective, though. USLM's 23.3 times P/E is certainly expensive compared to the broader global basic materials industry average, which is down at 15.7. But here's the real kicker. It actually looks like a total bargain compared to its direct peer group average, which sits way up at 34 times earnings. If USLM simply traded up to its peer average of 34, you'd be looking at an implied price north of $144. It really all depends on which yardstick the market ultimately decides to use.
Section 6. Synthesis and final verdict.
Stacking the implied fair values next to each other, we see a wildly fascinating range. Down on the ultra-conservative floor, we have Ben Graham's hard asset value at roughly $47. Right in the middle, aligning incredibly closely with the current market price of roughly $106, is the DCF model at $103. And up on the optimistic ceiling, the peer comparable model implies a value near $144. So what does this actually tell us? It tells us that the market is currently pricing USLM pretty efficiently based on its cash flows. It recognizes the premium quality, but it's not quite awarding it the lofty heights of its closest peers just yet.
So what should you ultimately take away from all this? Our final verdict for this explainer is a solid hold. Look, from a Buffett and Lynch perspective, this is a phenomenal, cash-rich business with a deep moat and massive insider alignment. But Graham's math doesn't lie. You are paying up for that quality. It is currently priced for absolute perfection, absorbing short-term earnings hits while it builds out for the future. The provocative question you really have to ask yourself as an investor is this. Are you willing to pay a slight premium today, completely ignoring short-term construction headwinds, to own a piece of a truly bulletproof monopoly tomorrow? Think about that for a bit, and I'll catch you in the next explainer.